Now, how do you build a $100 million company? What's the blueprint? And you have to look at it as the share structure of your company is like the skeleton of your body. So just like you have bones inside of your body to hold everything into place, you need a good structure so that, let's say, your muscles and everything else can be there, so you have a body, so you have a company, okay? So that's the same thing. So when you look at the components of a corporation, obviously you have the shell, so you have the actual share structure. You have the management team, which is you, and let's say your team members or your key members. Then you have the financing, which is the money that you get from your private placements, from your financing rounds. Then you have the specialists, let's say the geological team. Then you have the actual projects, which are, let's say, land, products, contracts, prototypes, whatever you have. Then you need to have a legal team, which is the securities lawyer. Okay, basically, it's not just any lawyer, it's a securities lawyer who specializes in this kind of business. And then also you need, let's say, administrational support. Let's say you have an assistant, like someone who deals with your paperwork and, helping you as an assistant in your company. Then you also need an accountant, so an accountant who does your financial statements, because once you go public, you need to file your financial statements every 3 months, so you always need to be on top of your financial statements. So you not just need an accountant for your own company, but you also need an auditor, which is an external accountant who will check whatever the accountant has done and double check and and so forth. But then you also need, obviously, the financial knowledge about private equity, about going public. Basically, this program here, so you know how the pieces work together. And then you need, let's say, promotion and marketing knowledge once you're listed, once you're publicly traded. Because just because you're listed doesn't mean that you have volume, that you have buyers, because people need to know that you're out there, okay? That's a whole other issue. And then you need, obviously, you need a network of people like, market makers and things like that who can help you, get the knowledge of your company out there. And obviously you want to have a strategic action plan for your business development, so your business plan and an exit strategy for the initial investors. And all those components and all those pieces, they all need to come together. And basically your job is to manage all this, to put it the right way, and to make it work. So we have basically two things we have to consider. Number one, we have, let's say, the IPO and financing side, okay? And on the other side, we have the business development of the company, okay? So those are two different things, but they run parallel. And you need to be aware of that. So how do you take a company public? Well, very simple. Obviously, you need to have a project or a idea or a concept or a product or whatever, okay? So you have a business concept, whatever that might be. And then you need 35 shareholders. That's the minimum. 35 shareholders who have at least 100 shares each, okay? That's the minimum. And then you need to have, it's called audited financial statements. So what does that mean? Well, you open up a bank account. You, everything that you do is being watched. Everything you do is being looked at and is being scrutinized. So you can't just, take your ATM card and take money out and do this and that. That's not how it works. So every expenditure must be accounted for, and it should be for a business reason. So let's say you pay yourself a salary, which is one thing, but then all other expenditures that you have to do something with the company, which means you have a management agreement in place, which says you're allowed to take out $5,000 every month for yourself because you're the management member. But then let's say you have a project that costs $20,000, but there needs to be an invoice or a contract or something that makes sure that the money that goes out and the paper that they go together. So everything needs to be accounted for. So at every 3 months, an accountant that you hire will look at the financial statements, will put it together, and then an auditor, which is an outside company who is regulated by the SEC, they will double check what your accountant has done, and they will get all the proof and paperwork, and that costs, can cost you $5,000 every 3 months for an auditor to check and double check your financial statements. But once you have those financial statements 100% checked and everything is in order, and the auditor basically gives their seal of approval, then what you need, it's a letter actually, then what happens is you need to file with the SEC, Securities and Exchange Commission, what's called an S1 registration statement. So what is that? An S1 registration statement is a filing that you file for your business. So let's say it's a 50-page document that explains everything about your business. Who is the management member? How many shares do you have issued? How much money did you raise? What are the project risks? What are the potential risks of the industry and so forth? So you explain every single last detail, basically, with chances and risks and everything, your entire plan, concept in that document. And it's a legal document, and it has to be done by your securities lawyer. And your securities lawyer charges, I don't know, $25,000, $50,000. I don't know how extensive it is. They will charge you a certain amount of money for that legal document. But that's the basis for your going public. So that everything is open. And that's the thing. That's the main principle. It's called that all the facts, all the risks, all the potential risks and factors are laid open, that are disclosed. Okay, so open disclosure is the main factor here for the SEC. Because they say basically, if an investor buys shares of your company, they need to be aware of what could go wrong. And if they are informed and everything has been disclosed, then, that's okay. And here's an interesting part with the money too. Technically, okay, and this is more of a joke, but technically, let's say you raise $1 million, you have to disclose how you spend the money. Let's say you go to Disneyland and we spend $1 million at Disneyland. Well, technically, it's legal if we disclose it, if we say, hey, we used the money for Disneyland. But what would be illegal is to say we invested into a project, but we actually went to Disneyland and we, cheated with the receipts. So the main thing is you can do whatever you want to do as a management member. You can decide to buy this project or that project or spend it this way or that way, as long as you disclose it and have proof for everything. So that someone can look at it and can say, well, based on whatever happened, it's reasonable or it's risky or whatever to invest or not invest. So basically disclosure is the main thing. So now you have a project, you have 35 shareholders, you have audited financial statements, and you have an S1 registration filing. Now the next step is this. The SEC has 60 days time, 60 days to look at your filings. And then they say, well, we send you back some comments, okay? And those are the comments. And let's say they send you 20 comments, just as an example, where they say, we need more clarification with this part. How do you mean this? What do you mean by business development here? And so forth. So basically, they ask for more clarification. Then your securities lawyer has to answer those comments, and they submit it again. So the S1 gets submitted one more time. And let's say they come back with 10 comments, and then with 5 comments, and eventually they say, now we're good. Now we declare the filing effective. So now the SEC says, all is well, okay? All is well from a disclosure point of view. Now you can basically go public. We have to maintain at the same time always the audited financial statements, so always have to every 3 months do that. And then also once you start the public going process, every major decision, every thing that is, let's say, not buying new pencils or something like that, but we buy a new project or we have a new management member. Something substantial has to be filed in an 8K, it's called, which is a current report. So all the bigger changes or things that could influence the development of the company have to be reported within 4 days. And it's an online system. So the SEC has an online portal. If you go to sec.gov, every company, everything they do is always filed immediately, and you can do it yourself. You can do it through a securities lawyer. I would recommend doing that. And then you are always current in regards to your reporting. And that's what it's called. It's called a reporting company. So your filing of your public company is called a reporting. And if you're a private company, basically just a regular company, it's a non-reporting company. So that's the difference. Okay, now once you have your filing effective, you need to have a market maker. And the market maker is someone who is a member of FINRA. FINRA is the Financial Regulatory Authority. Basically, it's the financial police, if you like. And what they do is they will assign the symbol. And your market maker has to sponsor you. So you have to find a market maker. You have to find a company who will say, we will sponsor you and we will apply with, it's called a Form 15C211. We will apply for you on your behalf for your company, and we will get the symbol. Okay, so the trading symbol. And once you have the symbol, the market maker on day one can then set the first price together with you as the company. And let's say you set your price range, let's say from $1 to $1.10, something like that. And that's when you execute the first price, and that's when you're public. So generally, so you can go public on your own with a securities lawyer by filing with the SEC and then being sponsored by a FINRA member, which is a market maker, and you set your own price in the beginning, okay? So that's called going public yourself. There's also obviously a way where an investment company and so forth can do all this for you, but that's the basic principle. So that's just, let's say, the legal side of how to take a company public. Now on the other side, okay, which is the business development side, obviously some other things have to happen too. Well, let's say you have an option, right? So you have an option to acquire a project. And then with that, you actually raise the first, $10,000, and then you want to acquire the first project, and it costs you $50,000, and you buy it. Then let's say you make a second round of financing, and you acquire, some, let's say $500,000. And with the $500,000, you buy, let's say, a second or third project, and you develop the existing project and so forth. So basically, then you do a work program and so forth. So you actually focus here on the development of your business. So with the money that you get in, how you spend it, what projects you acquire, what you buy. So this goes parallel. So you raise money, you do all the filings with the SEC, and at the same time, you build your company where you acquire projects, where you develop your projects, and this is happening at the same time. And what are the time frames? Okay, so it really depends. Let's say you can go public within 6 to 9 months. Okay, the 6 to 9 months is, let's say, the fastest way to go public. From idea, from start to going public. The first time when we filed Hemis, it took us 9 months for the SEC to be effective, and it took us about a year to have the symbol and everything and to start trading. So that's when we did it. The second time, the second company we took public, it took me 16 days for the SEC to approve, to make it effective. Okay, so this is, it can go faster or quicker or whatever. But typically you have 6 to, let's say, 12 months before you can go public. And that's a fast way. Now, that's what you can do. But better, okay? You don't want to go public and you're not ready with your company, with your development. You want to go maybe within 12 to 24 months. I mean, that's more of a still very fast, but that's more of a realistic time frame where you give yourself some time where you say, well, in the first year, we're going to acquire the project. We're going to raise the first $1 million. Let's say in the second year, you're going to raise the second $1 million. And then you have time, you have a couple of years to develop the business, to develop the projects, so that once you go public, you have already a certain valuation you're established. So those are about the time frame. So for your investors, somebody buys shares today, let's say 50 cents. And let's say they have to wait 1 or 2 years before they can sell, because that's the time it takes for you to go public. But then maybe they can sell it at $1, $2, or $3 in the market later on. So give yourself time. Don't rush things if you're under pressure. But at the same time, going public is a process that is not necessarily dependent just on you, but is dependent on the SEC, on FINRA, on certain legal steps that need to take place first. Now, how else can you go public? So let's say we just looked at, you can do the filings and all these kind of things, but you can also go public with what's called a reverse merger or reverse takeover, okay, depending on which country you're from. So this is how it works. Let's say we have a company, and the company is called ABC. And ABC is a company that was once successful. It's listed in the stock market. And for some reason, the business model died. And now it has zero money in it. The stock price is at 1 cent, okay, for example. The business failed, okay? The business basically failed, but it's still trading, it's still listed, it's still public, okay? And let's say here you are. Now you have your company, and your company is called, let's say, XYZ Corp, okay? And you have a great project, okay? You have money in the bank. You have a really cool management team. And you have everything that you need to make it successful. Now, what you can do is you can basically do a reverse takeover, which means it's a share exchange. So technically, ABC and XYZ do a one-to-one, let's say, share exchange, where now, if you owned a share of XYZ, you now own 1 share of ABC. And this whole company gets merged into this debt shell, so to speak. Okay, so it gets merged from here into here. So this ABC acquires the company with the money, the projects, and everything. Then ABC gets a name change, gets a management change, and now is called XYZ. See? Okay, so you can go public immediately. It takes about 30 days, so to speak, but immediately, and you can buy a listed company or listed shell that has been trading in the market. And there's different kind of prices, okay? And the prices vary and so forth. But it's possible that you buy a shell, let's say, for $350,000. That's debt, but the shell in itself, just due to the fact that it's actually listed and trading, you buy out all the shares, you pay $350,000, and you go public immediately. Okay, you go public with your concept, and you do a reverse merger or reverse takeover. And many people do that, or many companies do that. So instead of going through all the filings and this and that, you can do it the faster way by simply buying an existing listed shell. Let's look again at, let's say, a more typical share structure or a more typical way of going public. And let's say you have 0.001, okay, par value, which is, let's say, the initial share price, so to speak. And you, let's say, as the managed member, you acquire 10 million shares of your own company because it's an empty shell. And basically, you put up $10,000, and you put $10,000 into the company account. And then what you do is, let's say, you increase the price because you add a few things into the company. And what you do is you have a family and friends round the 10 cents. And let's say you sell 500,000 shares for 10 cents. And basically you raise $50,000 that now goes into the company. With that, you acquire another project, you do a first round of financing, and let's say at 25 cents. And at 25 cents, you do the first private placement. Let's say you sell 1 million shares. And obviously you raise, let's say, $250,000. Okay? And then, a few months later, you do a second round of financing of 50 cents. Again, 1 million shares. And you acquire $500,000. And then you do a third round of financing for 75, and then another 1 million shares, where you raise $750,000. Okay, and then finally you say that's it. Okay, we go public at $1. Okay, that's our first share price when we get listed. And you have 1, 2, 3. So 13.5 million shares issued. Okay, so those are issued and outstanding, which means they have been sold. 10 million belong to you and 3.5 million belong to outside investors. And the money that you have raised here is $1.56 million. Huh? So now you have this kind of money in your company and this amount of shares issued. And this is your current share price, okay? So now your job obviously is to use the $1.5 million here and buy the right projects, make the right decisions, and so forth, okay? So, but the key is you still have control of the company because you have the majority share position. And also, if you have here preferred shares, which have, let's say, 10 times the voting rights of the common shares that you basically sell here, then you also have a lot of control. And a typical share structure should be something like this, where let's say you issue 100 million shares, 20 million are preferred shares for the management team, and 80 million are shares for outside investors. And this is how it works. Let's say you have a treasure chest. Then that's why it's called the treasury. So you have a treasure box or a treasure chest, if you like. And what happens is you start with 100 million. 100 million are authorized. Authorized means that they're inside the box, but they're not out or issued or outstanding. They're still inside the box. And now we sold, let's say, the first 10 million shares. Okay, let's say I acquire the first million shares. Then basically 10 are out, but there's still 90 million shares left in the box for me to be issued. And now I issue another 3.5 million. So now the number here is 86.5 and so forth. So it goes down. So you see, the thing is that I have a maximum number of shares that I can issue, which is 100 million shares because that's authorized. That's what's been decided in the very beginning. That can be changed over time, of course. It can be, doubled or whatever. But basically, outstanding is 13.5 million, which represents, so to speak, 100% right now of the shares. Okay, so only 13.5 million or 100% of the company's shares that are out of the box, so to speak, okay? So that's what you have to understand. So obviously, the more shares you issue, if you issue too many shares and you have all of a sudden too many shares out there, then you're going to have a hard time maintaining a stable price. You're going to have a hard time raising capital and so forth. So you have to be smart about how many shares you issue, at what price, and you should know that plan of when to raise money at what price level from the very beginning. So you need to start with the end result in your mind. So let's say you take this as a basic structure. You can say, okay, this is how we're going to start. This is going to give me $1.5 million over the, let's say, next 12 or 18 months or something like that. This is the amount of shares that I'm going to issue, and this is the price level, and you're going to follow through exactly on this plan, and you don't deviate. So that's your financing plan. You know, obviously the numbers can change and whatever, but that's a very, let's say, solid structure to get things off the ground. And then, you know, you still have a lot of shares that you could potentially issue, 86 million. You know, you already have, let's say, a stable share price at $1. It's not just 5 cents or something like that. And you know you have $1.5 million where you already can start whatever operation or projects you want to get involved in. So make your plan in the very beginning, create the share structure, create the plan of how you're going to raise what at what price level, and then execute that plan. Let's say you want to build a $100 million company, okay? So let's say your goal is to create a valuation of $100 million. And then based on your financing plan or structure, you say you're going to have 50 million shares issued. Okay, so 50 million shares is what you're going to have issued and outstanding, it's called. So in order for you to create a company that has a value or a market capitalization of 100 million, you need to have a share price of $2, because $2 times 50 million shares is going to be $100 million. So that's your goal, or that could be your plan. So your goal, let's say, is to create a $100 million company. So you need to issue 50 million shares, and you must make sure that you generate a share price of $2. Now, how do you do that, okay? And because basically it's a basic calculation. It's obviously the amount of shares times the share price is the market formula. And there's two main formulas, and we're going to talk about them. So you have formula number one. You have the amount of shares, okay, times the share price, and that equals your market cap or your market valuation, huh? Capitalization, valuation, same thing, huh? So market valuation. That's one basic formula that you should know, okay? So because that has nothing to do with emotion, that's just simple math. And then the second one is you have your annual earnings, times and what's called a PE ratio. I'm going to explain that in a second. And that equals a, let's say, fair valuation, huh? Or fair market valuation. So what do I mean by that? Okay, let's give you an example. Let's say you have a restaurant, okay? And with your restaurant, you generate $1 million in annual earnings every single year. And the question I have for you is, for how much money would you sell me your restaurant? Would you sell it to me for $1 million? Because you make $1 million a year? And the answer is probably no, because if you already generate $1 million every year, just selling it for $1 million would be too cheap. So maybe you sell it to me for $3 or maybe for $5 million, because it would take me 3 or 5 years to basically generate from your annual sales and earnings, the valuation. So let's say you want to sell it to me for $3 million. So the factor is 3. So 1 million factor 3 is $3 million, let's sale price. So that's what's called the PE ratio, okay? But when you are in the stock market, the valuation is higher. So the minimum of, let's say, the old economy, the PE ratios is about 10, and the PE ratios of, let's say, the average is about 15, and some industry like technology can have, let's say, a PE ratio of 25. So 25 times the annual earnings equals the market, a fair market valuation. So what you want to do is you want to see how much is the annual profit or earnings of a company times the PE ratio, which is a factor, just a factor, and you can take 10 to 15 usually as an average, and then you have, let's say, what a fair valuation would be. Now in our example here, it's very simple. You want to say, okay, what kind of business do I need to create, okay? And let's look at this here. Let's to have a justification of $2, okay? So per share price. And let's say in my example here, let's say I raise $5 million, okay? Let's say I raise $5 million in 24 months, okay? Okay, let's say that's doable, okay? I've done it, it's doable. Okay, and now I'm gonna say, all right, $3 million is going to go into, let's say, an oil project, which generates a certain amount. Let's say it generates $10 million in, oil every year or whatever. Okay, so whatever I can, make happen as a business model. Now, let's say my annual earnings are 10 million. Okay, so 10 million earnings times, let's say I have a PE ratio of 10, which is somewhat conservative, then I can generate a fair valuation of $100 million in market value. Okay, so, maybe this was a little bit too fast, but the idea is this. If you have a concept where you generate some annual earnings with your business, times your factor here, then you're going to generate a $100 million company. Or, it could be simpler. You only generate $5 million per year in earnings, okay? So your company, your business model, whatever your products are, every year you generate $5 million in annual earnings. Because you have raised some initial capital, you used that capital well, you developed the company, and now you have great sales or cash flow. And now let's say your PE ratio is 20 because you are in a high growth industry, and then your market valuation is also $100 million. So basically, with a few $1 million that you raise, invest it the right way, generate more money, generate more millions, times a factor because you're listed in the stock market, gives you a $100 million valuation. And it's absolutely possible and doable. And sometimes there's companies out there, let's say tech companies, who generate zero or actually have losses, but they're still valued in the stock market for $500 million or $1 billion and things like that. Because people or the market believe in the potential of the stock, or the potential of the company, and so forth. So obviously, ideally, you want to create a stable company where you have actual earnings and actual profits that you generate with your business model. But sometimes it's not even necessary in the beginning to generate a $100 million company, you see? But you need to put yourself in a position where with the money that you acquire, you make the right kind of choices, you buy the right kind of projects, and then you have a high stock price. And sometimes the stock price doesn't always mean that it's the reality, because sometimes you have a bad or a company that has nothing in it or not much in it, just an idea or concept, but it's worth several $100 million in the stock market. And sometimes you have a very solid company and so forth, and it's undervalued. So sometimes it's just whatever the market likes. So choose your industry well, make the right kind of choices, and set yourself up for success. Now I want to give you also, let's say, a little bit of an example to play with, okay? Maybe all these numbers were a little bit overwhelming just now, but it's just important that you understand the basic concept, okay? So let's say you want to start small and you want to finish big, and you have an idea. And my sister-in-law, she actually had an idea for picnics, okay? So for general picnics. And she would charge, let's say, anywhere from, let's say, $150 to $300 per picnic, depending on the package for whatever people would like. So she would cook and organize and do all that kind of stuff. And she would call it Perfect Picnics, okay? So that was her idea. Now, if you want to play with that idea, let's say you make $100 in profit from those picnics, okay? And let's say she would, okay, so you make $100 in profits, okay, from one product. And then you can organize, let's say, 5 picnics a day. Okay, just as an example. So let's say your daily profit is $500. Okay. And then what you could do is she could, expand it into another city. She could hire employees. She could have her basic system multiplied and copied into other locations and so forth. And let's say she earns, $1,000 a day, okay, times, let's say, 25 days a month, for example. And let's say she makes $300,000 per year with her business idea, okay? So let's just as a basic example. But now she takes it even further, okay? She expands it to on a larger scale. And now the 300,000 turn, let's say she, makes it 10 times bigger, turn into $3 million in profits, okay, per year. So now she has it in 100 locations. And now she could say, well, I could sell it, or I could take it public. And if she takes it public, and let's say she has a PE ratio of 15, which is the factor, let's say her company would be valued at $45 million in the stock market. So she could potentially receive $45 million for her company, for all the shares, because now she has a system and it works. And so forth. So you see the basic range. So you can take something simple like picnics, something that creates $100 in profit only, and you can have a system that works, duplicated, multiplied, having different locations, different cities, different states, different countries, and so forth, and grow it, and then you could sell it basically at a higher value. And this is not utopia. There is a woman, she had 80 daycares. So she started with one simple daycare, and all of a sudden she had 2 daycares, and then she had a network of several daycares, and she sold it for $80 million, okay? So people with basic ideas, with basic concepts have expanded their business and generated multi-million-dollar businesses. And it's very doable and very possible. Obviously, you need the right kind of idea and passion and, and so forth. And it takes time and work, but it's doable if you set yourself up the right way.